we're coming towards the end of this particular semester, we will talk about liabilities next. So we've talked about assets, and then we'll talk about liabilities. We don't get into the owner's equity section until you're in the next portion of the class. But with liabilities, we're going to talk about the current liabilities, some of the major characteristics of bonds, how to account for bond transactions, how liabilities are reported, and how they're analyzed. First and foremost, what is a current liability? Current liability is a debt that a company reasonably expects to pay from existing current assets or through the creation of other current liabilities, and within 1 year or the operating cycle, whichever is longer. Debts that do not meet both criteria are classified as long-term liabilities. Different types of current liabilities are notes payables, accounts payables, unearned revenues, accrued liabilities such as taxes, salaries and wages, and interest. So to be classified as a current liability, a debt must be expected to be paid within. Which one of these answers is correct? Is it A, 1 year, B, the operating cycle, C, 2 years, D, A or B, whichever is longer? Hopefully, you chose D. We're going to start by talking about notes payables. Notes payables are when a company records obligations in the form of a written note. These are often used instead of accounts payables because they give the lender a written documentation of the obligation in case legal remedies are needed to collect the debt. They will require, as is the borrower, to pay interest and frequently are issued to meet short-term financing needs. They are issued for varying periods of time, and those that are due within 1 year of the balance sheet date are classified as current liabilities. Those that are due outside of 1 year of the balance sheet date would be classified as a long-term liability. So we're going to use the illustration of First National Bank, who agrees to lend $100,000 on September 1st, 2017, if Cole Williams Companies signs a $100,000, 12%. Remember, when we're given an interest, it's given to us in an APR, annual percentage rate. 4-month note maturing on January 1st. When a company issues an interest-bearing note, the amount of the assets it receives generally equals the note's face value. So we will receive $100,000 in cash, and we'll recognize that we have an obligation or a liability to pay $100,000 in notes payables. Now, through the life of the note, we need to record the interest as it accrues. In this case, because our financial statements are going to be prepared on December 31st, we need to accrue the interest that has been incurred through that date. For that, we have an interest expense of $4,000. That is $100,000 multiplied by 12% multiplied by 4 out of 12 months. We don't post that to notes payable because our notes payable is going to represent the face value of the note. We post that to our interest payable account. Now at maturity, Cole Williams Company has to pay the face value of the note plus interest. It records that payment by reducing the notes payable, reducing the accrued interest payable, and then paying out the $104,000 worth of cash. Another common current liability is sales taxes payable. Many of the purchases in retail stores are subject to sales taxes. Sales taxes are expressed as a percentage of the sales price. The seller collects that sales tax from the customer when the sale occurs, and they remit that tax that's collected to the state's Department of Revenue periodically. This usually occurs on a monthly basis. Most states require that the sales tax collected be rung up separately on the cash register, with the exception of gasoline sales and some of the more restricted items like cigarettes. You, as the retailer, are not collecting these sales taxes as any type of revenue for you. You are just a steward. You are a middleman. You are collecting it for the government. Never are they your funds. So let's look at how you would account for this. The March 25th cash register readings for Cooley Grocery Store shows that sales are $10,000 and sales tax of $600. There's a sales tax rate of 6%. 6% of $10,000, $600. So there should be cash received of $10,600, of which $10,000 is sales revenue and $6,000 goes to sales tax payable. Now, sometimes companies do not ring up sales tax separately on the cash register. When this happens, we divide the total receipts by 100% plus the sales tax percentage to determine sales. So we have the same situation here. They have a total receipts of $10,600. Because the total amount received from the sales is equal to the sales price plus 6%. We will have sales revenue of $10,000, sales tax payable of $600. So you can back into it if it is absolutely necessary. The next common current liability is unearned revenues. These are when companies like magazine publishers or airlines or anybody receives cash before goods or services are actually rendered. The companies will account for these as unearned revenues. When the advance is received, both cash and a current liability account identifying the source of the unearned revenue are increased. When the revenue is earned, the unearned revenue is decreased and the earned revenue account is increased. Let's just take a quick look at some entries related to unearned revenues. A common unearned revenue is season tickets. You purchase your season tickets at the beginning of the season. But when you do that, the football or the sporting organization has an obligation to provide you admittance to however many games that entitles you to. So Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The entry to record the sale of the tickets. We sold them for cash, so we will receive $500,000. That is 10,000 times 50. We recognize that as unearned ticket revenue at this point in time. Now, as we go through the period of each of the 5 games, we would record earning of the revenues accordingly. So we would have a reduction to our unearned ticket revenue of $100,000 per game and ticket revenue of $100,000. That's because there's $500,000 for 5 games. It's $100,000 per game. This next current liability is one that might throw you for a little bit of a loop. It is the current maturities of long-term debt. The current portion of long-term debt should be included in our current liabilities. Current maturities of long-term debt are frequently identified in the current liabilities portion of the balance sheet as long-term debt that's due within 1 year. It is not necessary to prepare adjusting entries to recognize the current maturity of the long-term debt. We just report it this way. At the balance sheet date, all obligations due within 1 year are classified as current, and all other obligations are long-term. So, for example, if you have something like your mortgage, where you have a principal and an interest payment every month, the portion of that principal, the portion of that note that you are paying for the next 12 months, not the interest portion, the principal portion, is the current portion of long-term debt. So Windy Construction issues a 5-year interest-bearing $25,000 note on January 1st, 2016. This specifies that each January, starting January 1st, 2017, Windy should pay $5,000 of the note, so of the face value, when the company prepares the financial statements on December 31st, 2016, they should have as their current liability. So what will they need to satisfy in the next year? Well, on January 1st, 2017, they have a $5,000 payment of that note. So it's $5,000. The remainder of that note, the other $20,000 of it, is long-term, is not due until out beyond that 1-year threshold. So the amount reported as the long-term liability is $20,000. The total of the two should equal the complete obligation of what is due for that given point in time. We're going to come to a do it. I would like you to hit pause and work out each of these situations. And then when you are done, press play. So you should have hit pause and you should be back to play. So for answer number 1, 50,000 times 12% times the fraction of the year. Remember, you have to remember that fraction of the year is $2,000. For number 2, $23,320 divided by the 106% gives us the amount of sales. The amount of sales is $22,000. We remove $22,000 from $23,320. That gives us sales tax payable of $1,320. And if $15,000 is collected in advance on November 1st for 3 months of rent, as of December 31st, we will have earned 2 of those 3 months, or $10,000. Next, we're going to touch on payroll and payroll taxes payable. We'll actually go into this much more in depth when we do Appendix I. Every employer incurs liabilities related to their employees' salaries and wages. One is the amount of salaries and wages that is owed to the employees. That's salaries and wages payable. The difference between salaries and wages is how they're paid. Salaries are an amount quoted monthly or yearly, whereas wages are rates per hour. Determining the payroll involves computing 3 basic amounts: gross earnings, payroll deductions, and net pay. Some of the liabilities related are those that are in relation to the withholding taxes of federal and state income taxes withheld from the employees, FICA taxes as withheld from the employees, and then of course there's the FICA tax expense associated with the employer. Until those that are withheld from the employees are remitted to the government taxing authorities, they are carried as current liabilities. The secondary type of payroll liability is those related to the payroll taxes that are levied on the employer. These payroll taxes are the employer's share of FICA and then federal and state unemployment taxes. So let's look at an illustration of a payroll. So Cargo Company Corporation records its payroll on the week of March 7th. They have a salaries and wages expenses, so all of the amounts, the monthly or the per hour amounts equal $100,000. From that $100,000, they have to hold the employee's portion of FICA, or $7,650, federal income taxes from the employees of $21,864, state income taxes from the employees of $2,922, meaning that the checks that they will actually write will be worth $67,564. Now, they're not writing these checks today. They're going to write them at a later date. So, when we actually go about recording the payment of these, we would reduce our salaries and wages payable by $67,564, and we would have checks or cash in the amount of $67,564 that would be paid to the employees. The payroll tax expenses that result from 3 taxes from government entities that are levied on employers are FICA, federal unemployment, and state unemployment. So we would then have, as well, the employer's expenses and liability entries that we would need to record. The total expenses add up to $13,850. $7,650 of it is related to our FICA taxes, $800 to our federal unemployment taxes, and $5,400 of it to our state unemployment taxes payable. Areas where a lot of employers get in trouble is with payroll taxes and not remitting them to the appropriate government jurisdictions. This is not an area that you want to be involved in, as it will be noticed eventually. It will be caught up, and there are some severe penalties that can be associated with not remitting payroll taxes to the government. So the employer payroll taxes, what do those not include? This is just the employer portion. And that is the federal income taxes. Those are withheld from the employees and remitted by the employer, but they're not an employer payroll tax. I want you to hit pause and give this a read, and then hit play and read what the missing controls are. You'll want to hit pause again as the missing controls populate. And we'll move forward to wages and payroll taxes. So I want to give you a minute to read all of this information. Notice that September wages are going to be paid in October. So we're not remitting any funds right now. And I want you to think your way through what these general journal entries for recording would be. Once you've jotted that down, then I want you to press play to see if you got this correct. Now I want you to move forward and do the same thing for the company's payroll tax expenses. Press pause, create the journal entry. Then I want you to press play and see if you got it correct. Not go ahead and go back and review this information just a little bit more. Remember, we're going to go more in depth at a later time, but this is the basic information you should be familiar with by the end of this chapter. Now we've really looked at pretty much all the basics related to current liabilities. Next, we're going to talk about bonds. And bonds are a whole nother ball of wax. So we'll end this one here and we'll pick up at a later